Let's imagine two people. Let's call them Alex and Sam. Alex works hard, saves money, and avoids unnecessary spending. Every month, like clockwork, Alex puts some money into a savings account. It feels safe, responsible, and kind of mature, right? Then there's Sam. Sam also works hard, but instead of just saving, Sam invests. Stocks, index funds, maybe even real estate. Sam is not trying to get rich quick, but believes that putting money to work is smarter than letting it sit. Fast forward 30 years. Alex has saved a decent amount. Let's say $100,000. That's impressive. That took discipline. But Sam? Sam has over $500,000, maybe more, and didn't earn more money, just made different decisions. That's the difference investing makes. But let's step back. What actually happens if you never invest? Let's talk about it. First off, I get it. Investing sounds scary. There's risk, weird jargon like dividends and mutual funds, and then there's that uncle who lost money in the 2008 crash and never stopped talking about it. So it's totally natural to feel cautious. And honestly, saving money is already a great habit. That's the foundation of everything. But here's the catch. If you only save and never invest, your money actually shrinks over time. Wait, what? How? Let me explain. It's something called inflation. And no, it's not just a word the news throws around when groceries get more expensive. Inflation is the slow, steady rise in prices over time. It means that what $1 can buy today might only buy you half a candy bar in 10 years. Sad, but true. Historically, inflation in the US has been about 2 to 3% per year. Some years more, some less. That means that if you just keep your money in a regular savings account earning, say, 0.5% interest, and inflation is 3%, you're actually losing purchasing power. You're not technically losing dollars. Your bank account still says $10,000, but those dollars buy you less. They're shrinking invisibly. It's like having a sandwich that slowly loses a bite every year. So over time, your savings alone might not be enough to protect your future. Now, this is where investing comes in. When you invest, you're essentially giving your money a job. You're letting it work for you, grow, compound, and hopefully outpace inflation. Let's use a real example. Let's say you put $100 per month into a savings account earning 1%. After 30 years, you'll have about $42,000. Not bad, but not great either. Now let's say you invest that same $100 monthly into a broad stock market index fund that averages 7% annual returns, which is pretty typical over the long term. After 30 years, over $113,000, same effort, same $100 per month. Huge difference. And if you bump that to $300 per month, that's over $340,000 after 30 years. This is the power of compound growth. It's like magic, but with math. So when people say time is money, what they should say is time is compounded money. But let's say you're still unsure. Maybe you're thinking, well, I don't need a big investment portfolio. I'll just rely on my job and Social Security. Here's the thing. Depending only on your job means you're trading time for money, constantly. If you get sick, burned out, or laid off, the money stops. And relying solely on Social Security, it might not be enough. The average Social Security benefit in the US today is around $1,800 per month. That's helpful, but it won't exactly buy you beachfront property or even a stress-free retirement in many places. Investing gives you a plan B, a backup engine running in the background, one that keeps working even when you don't. And here's a secret. You don't need to be rich to start. You don't need a finance degree. And you definitely don't need to be glued to the stock market every day. There are simple, low-cost investment options out there. Index funds, target date funds that are built for people who want to invest passively. Just set it, forget it, and let time do its thing. Now let's talk about another big fear, risk. What if I lose money? Totally valid question. Yes, the stock market goes up and down. There are good years and there are scary years. But here's the key. Over long periods, the market has always gone up. Since 1926, the average annual return of the S&P 500, a broad collection of large U.S. companies, is about 10% before inflation and around 7% after adjusting for it. That includes wars, recessions, crashes, and pandemics. But the people who panic and sell when the market drops, they lock in their losses. The people who stay invested, ride it out, and stay calm, they win in the long run. Think of investing like planting a tree. If you check it every day, it might seem like nothing's happening. But give it years, you'll have shade, fruit, maybe even a whole orchard. Okay, but what if you just don't want to deal with it? Let's be honest, not everyone loves personal finance. That's fair. But here's the deal. Not investing is still a decision. It's not playing it safe. It's choosing to let your money lose value over time. It's like saying, I'll skip brushing my teeth. but at least I won't get toothpaste on my shirt. Technically true, but also not a great long-term strategy. You don't need to be obsessed with investing. You just need to respect it enough to start. Even a little bit. Even $25 a month is better than nothing. It builds a habit, and habits are what build wealth, not lottery wins or sudden windfalls. Now here's another thing most people don't realize. Investing buys you freedom, not yachts and private jets, but real freedom. The freedom to stop working if you need to. The freedom to help your parents or your kids. The freedom to take a risk, start a business, or take a break without financial panic. Money won't buy happiness, sure, but options? Options are priceless, and investing gives you those options. Imagine being 60 and saying, I don't have to work anymore. That peace of mind? That didn't come from saving a few coupons or skipping lattes. That came from decades of small, consistent investing. So let's recap. If you never invest, your money loses value over time due to inflation. You rely 100% on your job or government support. You miss out on compound growth, and your future self might look back and say, why didn't we start sooner? But if you do invest, even just a little, you protect your money from inflation. You give it the chance to grow. You build financial independence over time, and you give future you a high five. The bottom line? Not investing doesn't mean you're safe. It means you're slowly moving backward without realizing it. Investing isn't about getting rich fast. It's about not falling behind. It's about building a future where you have control. So start small, start messy, start curious, but just start. Your future self will be really, really glad you did.